Let us examine the impact of stock buybacks on stock prices and shareholder value. The impact of stock buybacks on stock prices and shareholder value. Stock buybacks can significantly influence stock prices and shareholder value in several ways. Number one is increase in stock prices. Increase in stock prices. So in this case, you have reduced share supply, reduced number of shares outstanding. So when the company repurchases its own shares, it reduces the total number of shares available in the market. And so with fewer shares in circulation, the basic principle of supply and demand often drives up the share price. Assuming demands remain steady or increasing, wherever there's demands tends to outstrip supply, you discover that the share price would climb. So we also have a market perception. Market perception. A stock buyback can signal to investors that the company believes that its shares are undervalued. This can boost investor confidence, attracting more buyers and pushing up the price, the price of the shares, the stock price. So market perception is very, very important because the market perceives that the company share is undervalued. That's why they are undertaking a buyback, and then you discover that investors will key into the shares, and then the share price will eventually begin to climb. Number two, higher earning per shares. Higher earnings per shares. In this case, we have improved earning per shares. There's an improvement in earning per shares. And as buybacks reduce the number of shares outstanding, the company's earnings are spread, over fewer shares, and thus increasing the earning per shares. This can make the stock more attractive to investors, as bigger earning per shares often indicates better profitability. Then it also, touches stock valuation. Stock valuation. With higher earning per shares, the company may appear more profitable, which could lead to a higher price to earning ratio. And not only that, investors might view the stock as more valuable, thus driving up its price. Once market participants view a stock price as being valuable or undervalued, they will bid up the price of the shares concerned. Number three, enhanced shareholder value. Enhanced shareholder value. So in this case, we talk about capital appreciation as well as return on capital appreciation. And the shareholders who hold onto their stock during a buyback period will see an increase in their shareholders, they could see an increase in their holdings as shareholders, and this could be as a result of an increase in stock price that is triggered by the shares and the share buybacks. You also have return on capital. Buybacks provides a way for companies to return capital to shareholders. So similar to something like dividend. However, instead of direct payout, buybacks lead to an increase in the value of existing shares, benefiting shareholders by potentially increasing the overall value of their holdings. Number four, tax efficiency. Tax efficiency. And so under tax efficiency, you have favorable tax treatment. There's that favorable tax treatment. For many investors, buybacks are more tax efficient way to receive value from the company compared to dividends. In many jurisdictions, capital gains from stock prices, from stock price appreciation, are taxed at a lower rate, than dividend, making buybacks a preferred method of returning capital. You discover that uh, capital appreciation is taxed at a lower rate than dividend. But dividend usually is taxed at depending on your income brackets. Please like this video and subscribe to this channel if you've not done that. Number 5 is improved shareholder control. Improved shareholder control. In this case, you're talking about increased ownership. Increase ownership. As the number of shares decreases, the ownership percentage of existing shareholders increases, which could be particularly valuable for large institutional investors or major stakeholders who want to maintain or increase their influence in the company. Usually, the more the company reduces share outstanding, the more shareholders we have, an increased percentage of the shares. And for institutions, they tend to have more control, more say, on the running of the company because of their increased level of ownership. There is a consolidation of control. Consolidation of control. So in some cases, buybacks can help maintain control within a specific group of shareholders, such as company's founder or key executives. By reducing the number of shares held by the public, you discover that executives will have more control. They can consolidate their control over the company because of the increased value the increased value of the shares they have, at their disposal. Number 6, long-term value versus short-term focus. Long-term value versus short-term focus. Let's consider, short-term impact. While stock buybacks can boost short-term stock prices and improve financial metrics like earning per shares, they may not always contribute to long-term value creation. If the company is using borrowed funds to finance the buyback or repurchasing shares at inflated prices, it could hurt the company's long-term growth prospects. The company must not or should not borrow money, to finance buybacks. They should do that from the excess cash they generate. That should be the golden rule when it comes to share buybacks. Not only that, there's a long-term investor perspective. Long-term investor perspective. Buybacks should be viewed in the context of a company's overall strategy. If the company is repurchasing shares because it lacks better investment opportunities, example in research and development or expansion, the long-term benefit may be limited. Number 7, potential downsides. The potential downsides of stock buybacks. So in this case, you have on short-term focus. Short-term focus. Some critics argue that companies might use buybacks to artificially inflate stock prices, benefiting short-term shareholders and executives with performance-based compensation rather than investing in the company's long-term growth. And this debt risk. Debt risk. If a company finances its buyback by taking on debt, it may increase financial risk, especially if the market turns unfavorable or if there's an increase in the interest rates on the fund borrowed. The company might find itself in financial distress.